So one of the most dangerous moments in an agency's growth is landing a very big client. Revenue ends up jumping, confidence ends up rising, and frankly, the team ends up feeling validated. But something subtle begins to shift. Power starts to concentrate, and when power concentrates, leverage disappears. If one client represents a large percentage of your revenue, you don't have a growth advantage, you actually have a structural vulnerability. In this video, I'll show you why revenue concentration silently destroys agencies and how to structure your client base so no single account can threaten your business. So here's the reality is that there can be a little bit of a disillusionment that happens, right? Large clients can create the appearance of stability, that strong monthly revenue, predictable cash flow, and then creating for this like perception of security. Stability built on one pillar alone isn't stability. It actually is just concentration risk. So here's the reality, and the way that I want you to think about it, we'll go into the depth of it. But when one client carries too much rate, it ends up just creating growth becomes incredibly fragile, because the reality is if that one client changes their mind, they change direction, it just poof, all of your structure ends up completely going away. All of that stability is gone in an instant. So and this is how it ends up quietly shifting the power dynamic. So when you have this massive revenue concentration, the negotiation confidence ends up decreasing for you. You end up softening your boundaries, because the reality is that you start to, because of this revenue concentration and the recognition that them changing their mind, going in a different direction, selecting another agency, reducing their spend has significant problems for you. So you hesitate to raise prices, you hesitate to enforce timelines, you hesitate to push back on scope, you hesitate to say no to them because the perceived downside feels frankly just catastrophic, and in a lot of instances really can be. And so the power entirely then starts to shift or is entirely held by the client. And when that leverage component ends up moving away from the agency, it creates for the entire wrong dynamic across the entire agency, from the owner to account managers to the people directly in projects. They just understand that the power dynamic has completely shifted. And what ends up happening is that this decision quality decline ends up just precipitating across the entire business. So that revenue dependency impacts the leadership's psychology of how it is that they engage with this account. So we end up with strategic decisions become more protective versus expansive. So we are focusing entirely on what the perception of this strategic direction is going to be perceived by this one specific client because of the amount that they actually end up meaning. So we end up starting to look at things more from a risk tolerance decrease perspective of, we just end up feeling that the risk is always too high with any movement that we have. So we end up completely being frozen in time, frankly. And so you end up optimizing your retention at any cost. You have to keep this account. And so your innovation slows, the way that you react to things, the way that you adapt to things, and you stop asking this question that is pivotal, is what is best for the agency? What is best for our growth? And you start asking, what is going to keep this client happy? And it is one of the biggest problems that I see happening across the entire industry is do whatever we need to in order to keep this client happy. And that shift erodes your long-term growth, stability, and capability. The next thing it ends up doing, right, is it ends up having margin compression, because the reality of the world, it isn't getting any cheaper. As much as politicians may want to try to tell you that it's going to, it isn't getting any cheaper. And so larger clients often negotiate a lot harder. And so they have deeper discounts. They end up requesting custom things on an ongoing basis, things that you end up having to learn. The scope creep becomes normalized in the work that they're doing. And that profitability or average hourly earning ends up declining across the entirety of that account, or even across the entirety of the business. Because when you're introducing fear into your pricing decisions, you end up just sitting from a negative component. The reality of the world is you also have things getting more expensive while pricing staying the same. So if you're fearful to increase the price point, you just have margins. So you have revenue staying the same, margins continuing to grow, and you just end up continuing to lower your margins across the entirety of the business, specifically for this account, especially if this is a huge anchor client. Now, the thing that this ends up happening as a team level consequence is that you end up prioritizing the client over the team. And so resource allocation starts to get skewed towards one account. Other clients start to receive less strategic attention because every single time this client says jump, you're looking at a high. So you end up having churn on the other accounts aside from this one. Team morale completes entirely tied 2-to-1 relationship, whether someone likes this specific account, whether they woke up on the right side of the bed that day. So your entire culture of the agency becomes entirely tied to this one client. So burnout risk ends up increasing because you're doing whatever it is to keep this client happy. And it could be overnight, it could be over the weekend, it could be last minute things, it could be ignoring other clients. And it ends up leaving this kind of just morale collapse across the entire agency. And so you end up with this like emotional dependency with this client as well. And it's just very unhealthy. You end up being in a very unhealthy oriented relationship. And so here's the threshold that I like to look at, is that ideally no client represents more than 10%, but as you start to get into 15 or 20% of total revenue, there is a structural risk that you end up having. The reality is that even 10% of revenue is a meaningful decline, and 10% of revenue does mean that you're going to have to start making some adjustments. But as you start to get to 15 or 20% of total revenue, that means that you largely have wiped out most, if not all, of your profit. And so anything above that threshold, you need to start looking at a couple of things. But here's what's happened. Your negotiation posture ends up weakening across the board. Your decision-making becomes entirely reactive to what's going on. And the ability that you have for growth just completely narrows. And so it becomes very psychologically difficult to challenge them, but also challenge the place that you're in, even if you're not willing to admit it. So let's talk about this from an architecture perspective. I'm not suggesting that you go and fire your largest client today, especially if it means it's 70, 80% of your revenue. And nor am I telling you that if you have a large client come knocking at your door, that you should tell them, piss off, we are not accepting revenue from you. I'm not saying that either. What I want you to start to think about is more about the architecture of how it is that you're going about managing things. So high-performing agencies are intentionally structuring a couple of pieces. They're thinking about no single client above any of the others. The reality is you need to start to look at the product mix of what's going on. And then how do you go about spreading revenue across different tiering and having different size accounts, and that you have them based on this kind of tiering. And then understanding how you can create for more predictable revenue securing model. And so we'll talk about some like structural things that we want to go through, but the reality is that you shouldn't have a departure from your existing direction of what it is that you want to do as an agency and as a business that is going to be disturbed by this one power dynamic. And you just have to be careful of how it is that you engage with this. Now, how can you go about restructuring or redesigning your revenue distribution so that it is more healthy? So maybe you want to look at what exactly is this revenue cap. So like, what is the total percentage that you're willing to take as a risk? When you look at your profitability within the agency, we're at 25% profitable. One account being lost at 10% is not going to be great, but it is survivable. A client that's at 20% is not going to be survivable, so our cap needs to be at 20%. And so once anyone reaches or gets close to that threshold, to that cap, that maximum revenue per client, that concentration, you start to look at a couple of things. How can I increase my acquisition focus? How do I look about diversifying the verticals by which we are currently operating with existing accounts? How do I add on new retainers? How do I add on new projects with existing relationships? Not saying that you're not thinking about it, but you need to be more active about it. And then starting to think about a couple of things is, how do you start to think about accounts in its given matrix, right? So you've got anchor clients that are doing the same kind of revenue, they're stable retainers or stable amount of projects every given year. It's not adjusting up or down in a large amount. But then you start looking at growth accounts, the ones that have a really immediate expansion potential, that you're able to grow 2, 3, 4, even 50% growth year over year in the amount of activity that they currently have with you. And then start to set target growth amounts for each one of these given accounts. And then starting to look at what accounts do you have that are potentially experimental, ones that you can start to engage with and start to do a little bit more of like the strategic upside component of it, of how do you go about doing things new? How do you go about adapting the model slightly? How do you go about inventing and moving into the bit more of the modern era of just allowing things to be a bit different and continually inventing? The thing that becomes really important here is that if you have this balance meaningfully, it ends up removing a lot of the fragility of your business, and it allows for you to be able to be in the right kind of power dynamic and starting to look at how things can be managed appropriately. And then an important distinction, but you want to be looking at what it is that you have from a margin discipline of like, here's the minimum that we are willing to accept, no below this. The reality is you're not going to discount your fees for size alone, but the reality is if you have a multi-million-dollar contract put in front of you and they're going to ask you for a 5% discount, frankly, am I willing to say no to $600,000 worth of profit because I'm going to give them a discount of 15 grand? No, right? I'm not willing to do that. However, it is important for you to understand what it actually looks like and how are you creating for problematic scenarios. So profitability should remain as proportional as you possibly can make it, but also making sure that you're looking at things appropriately and holistically across the business, that you're looking at it and truly from a net margin perspective of what is the minimum that you're willing to accept. And there's just no point in doing business that you're not making money on, and making sure that you're keeping things appropriate. The other piece is you have that given cadence that a lot of agencies end up being stuck in. It's like, I'm focusing a lot on biz dev right now because revenue's down, and then I've secured the revenue, and then now I'm focusing on delivery, and then a client goes away, so now I'm focusing on biz dev again. Like, you need to keep things like a baseline amount of continuity across your pipeline development. The fuller your pipeline is, the less of the impact that this is going to have psychologically on you. That dependency ends up decreasing when you have a higher pipeline value, and it allows for you to be able to have growth as a main active component of what you're currently doing. And so I want you just to reframe a component of these core anchor accounts. Big clients do not actually mean security in the way that you think about it. They are a responsibility that you need to manage appropriately. And the goal isn't to just land one large account, one big whale. Frankly, it would be better to, jumping down this analogy maybe a little bit too far, but landing several dolphins rather than one large whale. It's a bigger animal, but allows for you to be able to be in a place that is more manageable. And you want to build a system around how this actually is going to engage with your profitability if this account actually goes away, because it can be incredibly destabilizing for a business. And frankly, I've seen many agencies either get to the brink of destruction or completely destroyed from these types of things. And making sure that you have meaningful stability. So revenue concentration doesn't end up just killing agencies suddenly. The change in the decision from these anchor accounts and allowing for it to maintain for too long is what is the silent killer. It erodes leverage slowly. It weakens your decision-making quality and quietly across the business. It ends up compressing your margins subtly over time. And by the time it becomes visible, growth has slowed or you're starting to shrink. And then the catastrophic moment happens when they end up deciding to go in a different direction. And that power dynamic is incredibly important for you to make sure that you understand that. If one client represents too much of your revenue, the problem isn't just distribution, it's positioning. Because when growth depends on landing a few large accounts, you don't have demand leverage. You have concentration risk. Strong agencies don't rely on one or two dominant clients. They build positioning that attracts consistent distributed demand. So if you want to understand why agencies struggle to create that kind of demand in the first place, go watch my video, Why Clients Don't Choose Your Creative Agency. Because without strong positioning, revenue will always concentrate around whoever says yes. I'll see you there.